So if these attacks continue to escalate, what will it mean for the price of oil and both the global and domestic economy? We're joined tonight by Kyle Cooper, an analyst at Ion Energy. Kyle, welcome. Nice to have you here.
Hi, and thank you.
Many of us were surprised that we didn't see a bigger reaction on the close in crude oil. Why do you think that is?
Absolutely. I think that the biggest overriding factor that is limiting these price increases is the recent trend in U.S. inventories. The preceding 12 weeks have seen U.S. total petroleum inventories rise 91 million barrels. And that's second only to a little over 92 million barrel increase registered all the way back in June of 2001. So with ample inventories, there's simply less fear that a supply disruption would truly cause a physical disruption.
Having said that, though, as we pointed out at the top, it's been a while since energy prices have responded to a geopolitical event like this. Is the market trying to tell us something this time around, do you think?
Yeah, absolutely. I think it still goes back to those inventories. Quite simply, the world is more comfortable since U.S. inventories are so robust, and also they're worried about the continuing implications of trade tariffs and what an escalation here would do to the global economy and thus demand. So there's really been a huge demand focus, and this actually, while certainly highlighting the supply risk, also points to that possibility of lower demand.
And how much of a reaction would you see, do you think, on a global basis, given what the president said, that we're not ready to make a deal? These attacks, these are not the first attacks, and we don't have a trade deal yet with China. What are your longer-term expectations?
Right now, I'm still a little bit bearish in the near term, just because in general, if you look at the market over the last year or so, the market was very bullish up until the October of 18 high of almost $77. It collapsed into December of to 42.36. Then it ran back up to 66.60. Now we've had a bearish trend, and right now, as you mentioned, you know, had this event happened 2 months ago, I think we'd have been up $3 to $4. And so I think it reflects the current sentiment that actually is still quite bearish across the market.
What do you think OPEC does with all of this? I mean, they've been trying to keep prices going up anyway as they hold the line on production cuts. So, but in light of what's going on between Saudi Arabia and Iran, what do you think OPEC does with it?
Absolutely. At a bare minimum, they're going to try to keep the current production in place. And also to highlight kind of the bearish sentiment is there was a report that Algeria was floating the idea of possibly increasing the current production cut from 1.2 million barrels to 1.8 billion barrels, and the market just doesn't believe it. So at a minimum, they're going to try to keep this level, and I think Saudi Arabia would like to see even further production cuts.
Does it have implications for monetary policy?
Certainly does. I mean, while the Fed doesn't say they react, and you know, they a lot of times look at CPI excluding energy and food. Clearly, the sentiment it would be detrimental if prices were to rise significantly as a result of a confrontation. But right now, obviously, that's not a problem. Import prices today were lower and even actually a little weaker than expected. So right now, there's not a problem with the inflation, but certainly it could be. And certainly if there was a true escalation, that significantly spiked oil prices.
All right, Kyle Cooper with Ion Energy, thank you very much.
Thank you. Have a great day.